In the Forex market, trading activity is generally divided into three major sessions: the Asian session, the London session, and the New York session. Technically, there is also a fourth center, Sydney, which opens the trading week and slightly precedes Tokyo, though most traders fold it into the broader Asian session. However, knowing when each session opens is only the beginning. Traders also need to understand which currency pairs perform best during each period, where liquidity is concentrated, and how currencies behave in relation to one another throughout the trading day. In this video, we will break down how the major Forex sessions affect currency pairs, liquidity, volatility, and correlation. By understanding which currencies are active during each session, you can focus on markets that are more likely to produce clear movement, instead of wasting time on pairs with limited participation. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. The Forex market includes 7 major currency pairs. These pairs are among the most actively traded instruments in the world, which usually gives them greater liquidity and tighter spreads compared with many minor and exotic currency pairs. Let's name them quickly, because you'll see them all the way through this video. Euro-USD. The euro against the US dollar is the most traded and most liquid, with the tightest spreads. USD-JPY. The US dollar against the Japanese yen trends cleanly and reacts to interest rates and risk sentiment. GBP-USD. The British pound against the US dollar, and nicknamed cable, moves faster and needs a wider stop. USDC, the US dollar against the Swiss franc, is a safe haven that often mirrors Euro-USD. USD/CAD. The US dollar against the Canadian dollar, and known as the loonie, follows oil and the North American session. AUD/USD. The Australian dollar against the US dollar, and called the Aussie, is a commodity currency tied to risk appetite and Asian demand. And USD/NZD. The US dollar against the New Zealand dollar, the Kiwi, is commodity-driven too, with a little less liquidity and sharper moves. Notice that every one of them contains the US dollar. That is no coincidence. Forex is the largest and most liquid market in the world, trading about $9.6 trillion every single day. And according to the BIS survey from April 2025, the dollar sits on one side of roughly 89% of all of those trades. That is exactly why the dollar, and the sessions where it is most active, carry so much weight over these markets. Because major pairs often have lower trading costs and stronger market participation, they naturally attract more traders. However, this does not mean that every major pair is equally active at every hour of the day. The session being traded can significantly affect liquidity, volatility, and price behavior. The first major period is the Asian session, which runs roughly from 000 to 9000 Coordinated Universal Time. During this session, trading activity is concentrated mainly around the Japanese yen, the Australian dollar, and the New Zealand dollar. Gold can also experience movement during this period, although its activity may vary depending on market conditions and current economic developments. This information is important because it helps traders identify which pairs are more likely to have sufficient liquidity during the Asian session. A currency connected to an active financial center will normally receive more participation than a currency whose main market has not opened yet. For example, trading the British pound against the US dollar during the Asian session may not always be the most effective choice. The main financial centers connected to the pound and the dollar are not operating at full capacity during most of this period. As a result, GBP-USD may experience lower liquidity, reduced volatility, slower price movement, or irregular consolidation during the Asian session. There can always be exceptions, especially when important news is released, but the normal session structure may not provide the clean movement traders are expecting. Instead of choosing a pair randomly, traders should focus on currencies that are actively participating in the current session. This allows them to trade where institutional activity, transaction volume, and liquidity are more likely to be present. Currency correlation is another important factor to consider. During the Asian session, pairs such as USD JPY, Euro JPY, and GBP JPY can sometimes move in a similar direction because they all share the Japanese yen as the quote currency. Two of these, Euro JPY and GBP JPY, are what traders call crosses because they do not contain the US dollar, while USD JPY is a major. What groups them together here is simply the shared yen. During this period, the yen may become the most active currency inside these pairs. When the yen strengthens, these pairs may move lower together. When the yen weakens, they may move higher together, creating a noticeable correlation across multiple yen-based markets. However, this relationship is not guaranteed to remain perfectly aligned. The US dollar, euro, and British pound can still react to their own economic news, market sentiment, or institutional flows. Correlation should therefore be treated as useful context, not as a fixed trading rule. A pair involving two currencies that are active in the same session can behave differently. For example, AJPY combines the Australian dollar and the Japanese yen, both of which can receive considerable participation during the Asian session. In this situation, price movement depends on the relative strength of both currencies. If the Australian dollar is strengthening while the yen is weakening, AUD/JPY may produce a strong directional move. If both currencies are moving with similar strength, the pair may become slower, less directional, or more difficult to trade. This leads to an important principle. When searching for a trade, it can sometimes be easier to analyze a pair in which one currency is clearly more active or dominant during the current session. Pairs such as GBP/JPY, Euro JPY, or USD JPY may provide clearer movement during certain parts of the Asian session, when the yen becomes the main driver. However, traders must still confirm direction through price action, market structure, volatility, and the broader market context. The next major period is the London session, which runs roughly from 8 a.m. to 1700 Coordinated Universal Time. London is one of the most active trading centers in the Forex market, and this session usually introduces significantly more liquidity and volatility. In fact, the United Kingdom alone handles about 38% of all global Forex turnover, which makes London the single largest trading hub in the world. During the London session, the British pound, the euro, and the Swiss franc become more active. Gold also tends to receive increased participation as European traders, institutions, and financial centers enter the market. The same session-based concept applies here. Traders should look for currency pairs that contain currencies actively traded during European market hours. Pairs involving the pound, euro, and Swiss franc may provide more opportunities as liquidity expands. However, greater activity does not automatically mean that every pair will trend. Currencies have relative strength and weakness, and this relationship plays a major role in determining whether a pair moves directionally or remains trapped in consolidation. Consider Euro GBP during the London session. Both the euro and the British pound are actively traded during this period. For the pair to create a strong directional move, one currency normally needs to outperform the other. If the euro is strong while the pound is weak, Euro GBP may move higher. If the pound is strong while the euro is weak, the pair may move lower. The clearest movement usually appears when there is a meaningful difference between the strength of the two currencies. If both currencies are equally strong or equally weak, neither side may gain enough control to create sustained movement. In that situation, Euro GBP may consolidate, move sideways, or produce unclear price action that is more difficult to trade. This is why traders should not analyze a currency pair as a single instrument. Every Forex pair represents a comparison between two separate currencies. The direction of the pair depends on the strength of the base currency relative to the strength of the quote currency. This is exactly where relative currency strength becomes a practical tool. Instead of staring at a single pair, you compare which currencies are broadly strong and which are broadly weak, and trade the pair with the widest gap between them. A currency strength meter makes that comparison much faster. The final major period is the New York session, which runs roughly from 1300 to 2200 Coordinated Universal Time. During this session, the US dollar and Canadian dollar become highly active. The British pound, euro, Swiss franc, and gold can also remain active, especially while the London and New York sessions overlap. The London and New York overlap, roughly from 1300 to 1700 Coordinated Universal Time, is often one of the most liquid and volatile periods of the trading day. During this window, traders from both Europe and North America are participating in the market at the same time. Keep in mind that all of these times shift by about an hour when daylight saving time is in effect. It also helps to watch the economic calendar, because high-impact releases, especially US data, often published around 12:30 to 1400 Coordinated Universal Time, can inject sudden volatility, regardless of which session you are trading. By contrast, the quietest stretch is the gap between the New York close and the Asian Open, a low liquidity window where spreads widen and moves turn choppy, so many traders simply avoid it. This overlap can create strong movement in pairs involving the US dollar, British pound, euro, Swiss franc, or Canadian dollar. Gold can also experience increased volatility because it is heavily influenced by the US dollar, interest rate expectations, economic data, and global market sentiment. A useful way to read the dollar here is the US dollar index, or DXY, which measures it against a basket of major currencies. When the DXY trends strongly, it pushes every dollar pair with it, lifting USD JPY and USD CAD while pressing Euro USD and GBP USD lower, or the reverse, giving you the broad dollar bias behind all these markets at once. This also explains some classic correlations. Euro USD and GBP USD tend to move together, since both are the dollar against a European currency, while Euro USD and USD CHF tend to move in opposite directions, because the dollar sits on opposite sides of the two pairs. We can now return to the main questions. Which currency pairs tend to work best during each session? Which pairs are more likely to have strong liquidity? How do currency correlations change throughout the trading day? The most suitable pairs are generally those connected to currencies that are active during the current session and showing a clear difference in relative strength. Higher liquidity can produce tighter spreads, smoother execution, and more consistent price movement. For example, GBP JPY can receive significant participation during the London session because the British pound becomes active, while the Japanese yen remains an important global currency. The pair can also remain active during the New York session, particularly while London is still open. However, GBP JPY is influenced by both the pound and the yen, not by the pound alone. Its direction depends on the relationship between the two currencies, along with risk sentiment, economic news, liquidity conditions, and broader institutional positioning. Currency correlation also depends on which currencies are driving the market during a particular session. USD JPY, Euro JPY, and GBP JPY may become positively correlated when broad yen strength or weakness becomes the dominant market theme. For example, if the yen weakens across the market during the Asian session, several yen pairs may rise at the same time. If the yen strengthens, those same pairs may decline together. This creates correlation because each pair shares exposure to the same active currency. The same principle can appear in other sessions. During London, broad strength or weakness in the euro or pound can affect several related pairs. During New York, a major move in the US dollar can influence Euro USD, GBP USD, USD JPY, USD CAD, gold, and many other markets. The key lesson is that session analysis should not be used in isolation. It should be combined with market structure, liquidity, relative currency strength, economic news, volatility, and a clearly defined trading plan. A session tells you when certain currencies are more likely to be active. Relative strength helps you understand which currency may be leading. Price action then helps you decide whether a valid trading opportunity actually exists. By matching the right pair with the right session, traders can avoid many low liquidity conditions and focus on markets with stronger participation. This can improve trade selection, reduce unnecessary setups, and create a more disciplined daily routine. That concludes this lesson. Use the session structure as a filter, not as a guaranteed signal. Identify the currencies that are active, compare their relative strength, study how related pairs are moving, and wait for price action to confirm the opportunity. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, The mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.